the performance was negative on the stocks. Okay, so that's doing in the fourth quarter. And this quarter, I think, will be interesting because we will start hearing from CEOs, from management about some of those issues in the headlines. What are they seeing with inflation? How's that impacting their business? What are they seeing going forward? The geopolitical risks. Some of the stocks, some of these companies had to pull out of Russia. Now there's other fears about maybe things going on in China. With the regulation, maybe now they're seeing, is there a risk in China if we start trade war or sanction? So we get to kind of hear right now for the first time from the CEOs regarding like that last quarter, because we had a lot of stuff going on, right? With markets sold off based on all those uncertainties. And we see last quarter it was down. We'll see how stocks start to react this quarter, because I think that the market went down, kind of recovered everything since the beginning of the Ukraine war, and I think we're even higher at this point. And so things to think about: inflation. What are they going to say about inflation? What do they think about higher interest rates going forward? How's that going to impact their businesses? Because some businesses are very sensitive to that. What are they? Some businesses are very sensitive to higher oil prices. Their input costs. So this is a pretty important earnings period, I think. Well, how do you take it?
Yeah, no, I think it's how companies are viewing inflation will be on display. There are so many things that are of interest in this earnings season. And the banks, right. Actually, it's April 18th is Bank of America. So that's really the start of earnings season. I mean, everyone is, I think on pins and needles about these earnings seasons. You got to be really careful. If your strategy is trading earnings and you've been doing it, I mean, we saw it last earnings, right? The moves when earnings both up and down were dramatic.
Very dramatic. Yeah, we saw a lot of volatility last earnings, a lot of stocks, that basically had stock movements to the downside much greater than anticipated, even in the high cap stocks like Netflix, Facebook, and even to the upside like Google, where they reported earnings, and it was very hard to get in and out of stock than usual. So we saw that, much higher, much more volatility. Here, this is the NASDAQ. So we see here so far in the fourth quarter, what stocks that reported, 52% of them were higher, 48% were lower, but on average, they lost 9.9%, telling me that those stocks that were lower had much bigger moves to the downside than the stocks that were higher, right? So here we could see here it lost almost 1%, 0.9%, while the 3-year average you see gained 0.3%. So you could see down here, just the fourth quarter 2020, it had a greater decline than just this last one. So
we've had a really big rally off this invasion bottom, right? I mean, the market's almost back to where it was, or right there. So we're going in at near the market highs again.
It feels like the market first discounted the uncertainty, and then they just took it right back out and said, okay, it's a non-global event right now, right? So it's not going to have as big an impact on business and earnings and the economy. That's what it feels like right now, because we're seeing a rally kind of going, if it continues, you're kind of now starting to fight the Fed, because now the Fed has even more of a reason to raise interest rates faster, right? Because now they have the inflation, too much money out there. They're trying to, and if the markets are going up, you kind of you're giving them the go ahead of raising it even faster, in my opinion. So you're in a way almost fighting the Fed on that. But here's a distribution of those returns, and we could see that stocks in the QQQ Nasdaq 100 that had that were down more than 12% after reporting earnings. There are 6 of them. And if we look at the long-term average, we see about 3 of them. So that's twice as many as we usually see, below 9%. You could see here. So to the downside, that those wings we saw, to the downside much greater than usual, to the upside not as much, right? So to the upside much less. So if we take that as a percentage, you could see here stocks Nasdaq that gained more than 12% after reporting earnings, only 3.2% of those stocks that occurred, versus on average we see almost 5%, 4.9% gaining more than 12% after reporting earnings. On the other side, right, to the downside, we see that twice as many, right, more than twice as many. 3-year average, we see about 2.7% of the stocks losing more than 12% of share value after reporting earnings. This last quarter, 6.4%. So those in the wings, those extremes out there, you could see. And here's a distribution of returns, right? So you could see it's not a normal distribution, not a bell curve. So here, stocks that lost more than 15%, right? That bucket, you see how high that got versus the average. 3-year average of 1.9%. So those tails, you're selling those wings, could see 6.4%. More, what's that? 3 times more if we're talking about 15% losses or higher. And this bucket here, between 6 and 9%, those stocks that lost between 6 and 9%, much higher, right? 7.6 versus 11.7%. So that's just kind of giving you where the stocks repriced after reporting earnings, what kind of moves, versus historicals, we saw in the last quarter. So, well, I guess if you don't have any questions.
We did have one question from Laurent. He was asking, he's looking for how to screen for, I think he said strangles. What's the best way to screen for strangles? He was asked. That was his question.
So we don't have a screener we have one for straddles and iron condors. We don't have one for just strangles or, 5%, 10%. We don't have a screener for that. I'll see if I tried to put out the strategies that have defined risk first. Okay, so when we're talking about, even these, we put out, covered calls, naked puts, and even there I'm hesitant, to put those out before, putting out the defined strategies first, because I think if you could learn the defined strategies and know those, you'll get better at the other ones, right? So it's kind of like your learning curve should be starting at the defined, even though it's a little bit harder to learn, right? Because you have to then figure out, well, what's a spread instead of just selling the naked put. Why is it better? But you'll get better, I think, trading overall if you do it that way. So what we started to do is put out the defined strategies first. So that's why you see butterflies, iron condors, I did put out the straddles there, and that was even, people twisting my arm to do that. But you could see, look, vertical spreads, vertical spreads, butterflies, iron condors, And it's really because I think you would be, if you can trade these really well, you'd be much better at knowing like when to trade the strangles, you know. So that's why we kind of started doing it this way.
Yeah, and if you were looking, you could just look at the calls and puts if you wanted the screen as well, right? And
Yeah, I mean, you could look at, because with the iron condor, right? It's just going to give you similar to a strangle, except now what you're doing is you're, instead of just leaving yourself exposed to infinite losses, you're defining, what you're defining your max loss, right? So that's the iron condor, right? So we could take a look at what it looks like. I'm going to press it. Here's one in Microsoft with an edge, so if you click over to it, you could, what it will do is populate the legs. So see, populate all the legs, load the strategy. And you could see here, stock moves around and stays within that range. You keep that credit. It moves outside. You're just stopping your loss out, right? That's all you're doing, is you're just saying, okay, I'm going to stop my loss out in case we see those, and we're looking at those, wings, especially to the downside increased. But if you wanted to take it off and you feel comfortable, you could just, delete these. Here, delete these out. Then you just have, you have your strangle, but then again, you have, unlimited loss, really, right? You're never stopped out.
which can be painful.
Huh? It'll be
Which can
painful.
be
You'll
painful.
still get it, and most likely you're still getting this edge, right? If there's edge in the most likely the iron condor, there's in that same one. If you took out the wings, probably still have the same edge. You could check it this way, but it's just right to reduce. You're just reducing your risk. You're stopping yourself out. I think it's just a better way to go.
Yeah,
So,
perfect. Listen, the Iron Condor screener is released to everyone, right? Rob is saying it's not on his screener page.
No, if you're under screeners, right? I mean, as long as it's a premium feature, right? The screener, but yeah, you should. The iron condors are out there. So
Yeah, Rob, I would refresh your screen, and then if it persists, just take a screenshot and send us the screenshot to support at Market Chameleon. If the issue consists, it should be out there. Awesome job, Dina, as always.
Okay. Well, thanks everyone for joining. Stay safe out there. Have a great trading day, and we hope to see you